Welcome back to the Financial Sense News Hour with Jim Paplava and John Leffler at financialsense.com.
Joining us next on the program is Dave Rosenberg. He's chief economist and strategist at Glushkin Schiff. And Dave, you made a comment the other day about an article that was written by Bill Miller in the Financial Times discussing oil, commodities, and what we call the dollar debasement trade. At some point, it almost becomes counterproductive, meaning that as the dollar falls and if oil goes up high enough, it's going to impact economic growth. And there's some price to pay for that cheap money, the bad effects of inflation. Do you subscribe to that view?
Well, I think there's quite a bit of truth to it. You know, we had the situation with the Fed's QE2 program that was ultimately aimed at bolstering risk assets like the equity market, but at the same time, other correlated risk assets like commodities and particularly things that we have to buy, necessities like food and fuels, have skyrocketed, and as a result, we've had wages in real terms decline now for 6 months in a row. So it's almost like Newton's first law of motion: every action has an equal and opposite reaction, and in some sense, these QE2 programs, these quantitative easing programs, while they may have ignited animal spirits in investors, have created other distortions as well that have perhaps done more harm than good for the real economy.
Yeah, according to Miller, there's a lot of price or momentum and belief in the system. It's kind of like a trend that's once in place, keeps going until it bends eventually. How much do you think of, let's say, the rise that we've seen in commodity prices is based on true fundamental demand factors, in part based on, let's say, just cheap money that's going and looking for a place to park?
Well, we knew that commodity prices have been in a well-defined secular uptrend for the past 10 years. And then the question really is, in those periods where you get these sharp deviations from the trend line. The trend line in commodities is up. If China is some Ponzi scheme that implodes, I imagine that would have a deleterious impact on demand, and secular bull market would be over, because at least we know what the basic tenets are from the demand side. But what happened, and I think a lot of this was starting late summer with quantitative easing, is that the liquidity, or at least the perceived liquidity, if it's going to influence one asset class, like small cap stocks, it's going to have an impact on correlated assets, being commodities. And if you take a look, for example, how you can assess this is just go to the weekly commitment to traders reports and just go to the NYMEX futures and options to see what the net speculative long position is in a variety of commodities. In this particular instance, let's look at oil. And we had a situation a couple of weeks ago, for example, where the net speculative or non-commercial interest in oil contracts was triple what it was in the summer of 2008 when oil was touched $145 a barrel. So there's no question that whether it's a $10, $20, or a $30 premium that we had in the price of oil, and the extent to which, that may have been reflecting what was happening in Libya, the reality is that what we had for most of this year, that move, I would say, from $90 up towards $115, I treat not as a source of demand in real terms globally, which might be a beneficial increase in the price, but instead what it really has done is acted as an exogenous tax shock on the American consumer, which is why these consumer confidence indices really, although they're up off the bottom, the depression bottom, are still at levels that would be consistent with recessions in previous cycles.
Now, Dave, your long-term views on all of this have been more in the deflationary camp. Do you still hold those views given the rise that we've seen in, let's say, PPI, CPI, and the basic goods that we have to buy on a daily basis? And if you hold that view still, what are the main reasons behind it?
Well, firstly, let's go back to summer 2008. Once again, we have a massive commodity spasm, and everybody has inflation on the brain. If you actually go to the consumer confidence surveys, people thought we were going to have 6% inflation. Of course, we did get headline inflation at the peak when oil was peaking, and other commodities inflation did get to 5.5% at the highs in the summer of 2008, and a year later we were negative 1% on the inflation rate in a 12-month span. So something got in the way of that commodity boom, and maybe it was credit, maybe it was housing, combination of the two. As far as I could see, home prices are deflating. commercial real estate is starting to roll over again. We have a situation where there are now more than 6 Americans in the total pool of available labor vying for every job opening out there, and that's putting downward pressure on nominal wage growth. So the answer is that, statistically speaking, if we just take a look at a point in time, your answer is quite right, that we have these visible things we can't really substitute away from in the family budget, which is food and fuels. And commodities certainly are volatile, and they move like a sine wave over time. And that's where the inflation is. But you see what's happening at the same time is you can see it in the data. You can see what is happening to pricing in other parts of the economy, especially in the service sector, which is so sensitive to what's happening in the labor market. And that's what people tend to forget is that, yes, we have goods inflation stemming from the commodities, but 2/3 of what we as Americans spend money on out of the budget, well, 2/3 of that is services, not goods. 40 years ago, it was goods, but we've become more of a service sector economy. And you're seeing a lot of service sector prices actually still disinflating because they've been deregulated and they're subject to tremendous competition. And at the same time, there's only so much money right now in the family budget to spend. So you might get more inflation, say, in food and fuels, and that means that people have to cut back on other parts of the budget, especially the discretionary items. And I think it's those areas that will be deflating over the course of the next year. So I guess that's what comes down to that. Is this run-up in commodities really a sustained increase in the overall inflation rate going forward like it was in the 1970s, or is it really a relative price shift? And what it's going to do in a stagnant wage environment is force people to cut back on the other parts of the budget. That's going to force reduced pricing power in those other areas.
Could we, Dave, see a sort of bifurcated pricing mechanism in the economy? In other words, things like housing and maybe even assets would decline, and especially since a lot of these assets or large items like cars, homes are determined to some extent by credit. But on the other hand, because of, let's say, emerging market demand, the things that you and I have to buy on a daily basis, like groceries, gasoline at the pump, those things go up. So could we see deflation in one sector, inflation in another?
Absolutely. And that is what we're seeing, and it may well be that's what we'll continue to see. I don't think oil is going to go from 100 to 200 to 300. Remember, inflation is a whole process. That's what I mentioned before about just at a point in time. The 1970s was a whole decade of accelerating inflationary pressure. So what we're talking about here is, you're right, it's about relative pricing. With some prices going up, some prices going down. It's extremely, pernicious when the inflation isn't a part of the family budget that's so vital. We got to feed our kids and drive to work. And so it's not something we can substitute away from. If all of a sudden restaurant prices were to skyrocket, maybe we take the family out for dinner one fewer time a month and just eat at home. But when it comes down to the basic fabric in terms of your staples, food and fuels, it's a different sort of inflation. It eats away at your standard of living and your confidence. And what it does is it forces you to cut back on those other discretionary areas of the economy that you don't need. And that's where the deflationary pressure is probably going to come from, and the two are just going to wash out. But it does create, I think, social problems. There's no question about it when the price of necessities goes up as much as it has. And if that doesn't end up reversing course, it is going to be problematic, especially because when you consider what the inflation really was in the 1970s, and you talk about a whole process, was everybody had a COLA clause back then. We had a much more unionized, regulated, insular, and insulated economy protected from global competitive pressures. And what was interesting in the 1970s is that the real inflation, people look at commodities, but what happened was that service sector inflation actually went up faster than commodity inflation did in the 1970s. And the reason for that is because productivity stagnated for the entire decade, and yet wages went up 8.5% per year. Well, last I saw, productivity has not stagnated, but wage growth actually in this country is extremely anemic. And if you don't get the wages playing serious catch-up here, then the inflation that you're seeing in commodities ends up coming out of the pockets, for other producers and retailers out there that are involved in the commodity space.
Let's talk about what this might mean for the corporate sector, because if you take a look at the regional Fed surveys, the ISM, we've seen higher prices in the prices paid component. If that continues, or if it stays as it is without receding, what does that tell us, Dave, about profit margins in the future quarters ahead of us? Because, the markets have been elevated because the profits have been good. But what happens when, let's say, the cost of manufacturing, the input costs are going up faster than, let's say, what companies can raise their sales price due to competition?
Well, I think that is a terrific question. And the U.S. economy, as a standalone, say, entity, is a net raw material importer. And so this is a significant squeeze on consumers, also on producers, and there's no way that manufacturers or retailers can raise their prices as fast as their input costs are going up as it pertains to what's happening on the raw material side, which has, gone asymptotic just over the course, say, over the past year. So the choices for the corporate sector is that you either continue to make efforts to bolster productivity, and productivity growth, although it's not gangbusters, is certainly decent, and that's a help for profit margins. On top of that, we got to keep in mind that the biggest expense for any given business is labor. And when you have a U6 unemployment rate of 16%, what I mean for that is that the total level of underemployment and unemployment, that particular unemployment rate that looks at the whole gamut of the labor market, it's 16% total unemployment rate in the U.S., and that's putting downward pressure on wages, which isn't so great for the household sector, but that's the greatest expense for the business sector. So the way out of this for the corporate sector to maintain their margins without radically raising their prices, which I think is very difficult to do in the current environment, although some companies have been successful, but not nearly to the extent that they can offset their raw material price increases into their production process. So what they have to do is maintain solid productivity growth, which, by the way, they are doing, and at the same time clamp down on labor costs, which is what they're doing. But again, one company's labor cost is a person's income, and that's one of the reasons why wage growth has been so anemic. But that's really what, outside of that, if we lack the effort to boost productivity and contain or reduce unit labor costs, then what you're going to end up finding in the U.S. equity market and broad corporate sector is a very significant margin squeeze over the course of the next several quarters.
One thing that we've seen, Dave, in the last month, we've seen a number of softening in the LEIs. I think 5 out of the 7 were down in April. Are we headed for another slowdown, or will we see a bit of stagflation?
Well, as I said before, we're certainly going to get something called inflation. I just don't think it's going to be stagger in. I still think we have overall, in the aggregate, an overall deflationary backdrop. I think as it pertains to real wages, as it pertains to credit, as it pertains to real estate, there's still significant pockets of deflation. I don't have a big inflation view. I know it's very tempting to have that as you drive by the gas station, but just remember that we all had that view in the summer of 2008, and the inflation view back then didn't really materialize. We ended up getting a recession, and inflation came down. It wasn't a recession with inflation going up, which is what the stagflationary environment would imply. I think that the view that the economy is going to slow down is appropriate. In fact, it's not even a forecast. It's actually a fact on the ground, because we know that we had this QE2 euphoric lift in GDP growth in the fourth quarter of last year when we had 3.1%. I mean, think about it. It went from 2.6% GDP growth in the third quarter of last year to 3.1% in the fourth. Lo and behold, in the first quarter, we're at 1.8%. And half of that is inventory accumulation. And I'm not really noticing that we're getting any sort of meaningful impetus into the current quarter. So the economy has already slowed down. I think that's being reflected in the fact that bank stocks are down 12% in the past 2 months, and 10-year Treasury yields are down 60 basis points in the past 2 months. And usually you get bank stocks and bond yields going down in tandem. That is not usually a development that is foreshadowing very good things ahead on the macro front. So the answer is yes. I think that second half of the year, with the dramatic withdrawal of monetary and especially fiscal support, I think we're going to have a very sluggish economy between now and December.
This brings up a question, especially since 2012 is presidential election cycle. Dave, if the economy slows down, much in the way it was sort of doing so in the second and third quarter of last year, and let's say we start to see the employment numbers begin to rise, would we see, in your opinion, another round of quantitative easing or some new stimulus from Congress, especially given the fact that the greatest unemployment that worries politicians is their own?
Well, I think that at some point in 2012, there's a strong likelihood that we will see another round of quantitative easing. How it manifests itself, what shape it takes. It might not be a case of expanding the balance sheet. It could be a case of targeting 10-year Treasury yields to really give a push to the housing market. But all that said is that the bar for the next round of quantitative easing is very high. I mean, last year it's one thing to talk about a double dip, but don't forget that the S&P 500 was on its way, it's seemingly below the 1,000 mark a couple of times. We're at 1350 in the S&P. I mean, I'll just tell you that there's no QE with the S&P at 1350. But I would say that by the time we get the next round of quantitative easing, whatever shape or form it takes, the levels on everything, from the unemployment rate to inflation to home prices to the S&P, are going to be materially different than they are today. And I would hazard to say that, especially now that Bernanke and the Fed have come under such close scrutiny and actually disdain from so many people, that probably by the time we get to QE3, the same people that are lamenting and complaining about it today will be begging for it at that particular point in time. My belief is that we're in a very large book, probably a 600-page book called The Post-Bubble Credit Collapse. And people think that just because you complete a chapter or you double the stock market from the lows, but the book is not over. There's several chapters. People thought that the book was over in 1930 and 1931 as well, and then they got whacked in the head with 1932. This is going to be a long and drawn-out affair, as it usually is in the aftermath of a post-bubble credit collapse. So to say that QE is off the table, well, it probably is for the next 6 months. But if you go back to the opening months of 2010, the Fed was supposedly going to embark on its exit strategy. And lo and behold, by August, the Fed is crying uncle, and we had QE2, and that was not supposed to be in the cards in the opening months of last year. So we all know that Ben Bernanke is willing to be extremely aggressive, but when the time is right, it's certainly not going to be in July. But I do think that will we see at some point another round of monetary easing? I think it'll be necessary, but maybe not till next year.
Dave, as I look at what we're experiencing now, I think back to 2007 and 2008, where we had widening interest spreads between the U.S. and the rest of the world. They were tightening, we were loosening. At the same time, the dollar was going down. We saw rising commodity prices, especially in energy, and we saw rising inflation. It almost seems a little bit of deja vu. We still have widening credit spreads, the number of central banks globally that have been tightening interest rates versus our own. We have rising commodity prices, rising energy prices, but so far, and we have recently started to see a rise in, let's say, PPI and CPI, but we don't have rising interest rates. Do you see some similarities between these two time periods?
Well, there were similarities. Taken quite a bit of capacity out of the financial system since that time, and you can hardly argue that we have a housing bubble today. We certainly had back then, but it doesn't mean that home prices, looking at the broad supply and demand backdrop, don't have another 10 to 20% downside from here, which will have its own implications for the financial system and for consumer confidence. But in some sense, everything you said, I think was correct. I'm not so sure about corporate bond spreads. To me, they've been very tight. And now you're starting to see the return of covenant-like loans, being extended to the corporate sector. The terms have all of a sudden started to go in the favor of the lender as opposed to the borrower. I do find that there's similarities and there's differences. I think that there's a tremendous amount of complacency out there. Portfolio managers in the aggregate in the equity market are sitting on 3.4% cash, which is historically extremely low and even lower than it was before. The market peaked in 2007. You look at the investor intelligence polls, and they have 51% bulls and barely 18% bears. So you have this prevailing view that the first quarter was just a soft patch, and that we're going to reaccelerate in the second quarter. So the same people that were telling you we're going to have over 3% growth first quarter, and we're wrong, or saying we're going to have over 3% growth in the second quarter. So I only think that there's really, to that view, just downside risks right now. So there are similarities. I think a lot of the excesses have been taken out from where we were a few years ago in the banking system and certainly credit and housing. But I do get a sense that if we're taking a look at what the economy is likely to do in the second half of the year, benchmarked against what the expectations are and how the market is positioned, I think we're in for a very significant round of disappointment over the next few quarters.
I want to move on to a topic that's in the headlines, and that's the federal deficit. This year it's estimated between 1.5 and 1.7 trillion. And, of course, with next year being an election, there doesn't seem to be any real partisan agreement regarding whether looking at raising taxes or spending cuts. In addition to that, Dave, we have a looming large retirement population, the boomers heading into retirement, and not to mention the fact that we're involved in almost 3 wars. How long, in your opinion, can the U.S. continue to finance and run trillion-dollar deficits?
Well, it's a good question. And the answer is probably longer than anybody thinks. Just take a look at the Japanese experience, where their debt-to-GDP ratio is now 200%. And, of course, people say, well, they all fund it themselves. But in a globalized capital market, I don't know how much that really matters anymore. I don't want to downplay the fiscal situation. It is not a crisis, however. It doesn't mean that it can't become one at some point, and it's better to get ahead of these things. And we have not just a high deficit, record high deficit, but seemingly intractable and becoming increasingly structural, so better to get ahead of it now. I just think there's a lot of hyperbole, to be perfectly honest, and a lot of extreme positions being taken. But we're not in a crisis situation. If we were in a crisis situation, then no matter what the Fed has been doing, and $600 billion buying the short and mid part of the curve is really a drop in the bucket. If there was truly a massive fiscal problem here, long-term interest rates would be skyrocketing. Now, that doesn't mean that it can't happen someday, and, a stitch in time saves 9 and all that. But Canada had very similar deficit problems that the U.S. had, in fact, maybe even more entrenched back in the early 90s, and it takes just a lot of courage and a very strong political will to reverse the rising tide of red ink. I certainly understand that. But it can be done, and I think it will be done. There's no question between now and the election, taxes are not going to go up. Entitlements are going to have to be a post-2012 debate and national plebiscite. And I do think, though, that what the two parties will ultimately have to agree to get past this debt ceiling issue is how far will we cut the 15% of the budget that's discretionary that can actually be reduced to at least contain the deficit over the course of the next year. And I think that's where the cooler heads are going to prevail. But this is hardly a crisis. The U.S. is an extremely wealthy country. We talk about tax rates, but, when you take a look at the tax loopholes, in the tax system, that costs the public purse over $1 trillion per year. Just loopholes. Eliminate those, and you've taken care of 2/3 of the problem. There's going to be special interests and lobby groups. But for people that think that America can't solve its fiscal problem, yeah, you know what? A lot of it can be solved, and actually quite a bit of it can be solved without a whole lot of pain. And my sense is that that's what we're probably going to see. But I think a lot of the tough decisions naturally are going to happen after the next election, just as a lot of the tough decisions in Canada happened after the 1993 federal election.
Well, let's talk about what we see sometimes. We've had QE1, we've had QE2. Earlier on in the last decade, we had the housing bubble. David, are we likely to see another bubble emerge? Some would argue commodities, some would argue emerging markets. In other words, with all this liquidity floating out there, going and looking for a place for a return with zero interest rates, do we get another bubble?
Well, some people would say that looking at silver and gold, especially silver, which went parabolic just up until about 2 weeks ago, that sure looked like a bubble. It's quite possible, but there are ways that regulators can lean against it. I think in some sense that even Alan Greenspan back in the 90s could have used his bully pulpit a lot more to just talk about the speculation or some of the non-interest rate moves he could have made on the supervisory and regulatory front. So, the regulators, for better or for worse, whether you agree with it or not, have raised these margin requirements, which has helped take, I think, some of the speculative froth out of the precious metal complex. In the final analysis, it's really up to, and I agree with Ben Bernanke on this, I think it's absolutely ridiculous to have emerging market countries tie their currencies or their monetary policies to the U.S., which is at a completely different point of the business cycle and the inflation cycle that these emerging market countries are. So their currencies have to adjust more rapidly. They have to tighten their monetary policy more rapidly. And if they do that, then they'll find that, they'll be able to curb their inflationary pressures without relying on anything that Ben Bernanke's got to do. So there are solutions towards dealing with these other issues, whether it's an emerging market bubble or commodity bubble, that don't necessarily just rest with what the Fed's doing to try and maintain, when push comes to shove, social stability in the United States.
Given this kind of environment, how would you be investing? We've seen the things that have done well. But it seems like, Dave, that the risk trade, at least in the last week or two, has come off. We've seen healthcare perform very well within the S&P 500. We're seeing also, utilities start to break out. Consumer staples are doing well. Would you be investing more on a cautionary note here, given what you see?
Yeah, we here at Gluskin Sheff, we are bracing for and anticipating moving our clients' money into strategies that are going to benefit from a slower growth environment and from a heightened financial volatility environment. And when I say heightened volatility, they're actually strategies which can be deployed, which we do in-house, and they're relative value strategies, hedge fund strategies that really take the direction of the market out of the equation and focus on the price anomalies within the market, whether it's resources or whether it's fixed income or whether it's equity, that naturally develop in periods of heightened volatility. So we are actually prepared for that. And also at the same time within the equity market, a real focus on what's going to work in a slower growth environment. And that means strong balance sheets, dividend growth, solid ROEs, and large cap over small cap. And we can actually identify quite a few really bellwether blue chip stocks in the U.S. that we think will actually hold in very well, even in an environment of sluggish growth and heightened volatility. On top of that, still believe that corporate balance sheets are in good shape, and that notwithstanding the fact that a reduced growth in the economy will trim the corporate earnings outlook, which might be a problem for the cyclical segments of the equity market, balance sheets are in good enough shape that they should be able to withstand that. So we continue to maintain a very sizable share of our client assets in our fixed income strategies, which are working out very well. So that's really what I'd be focused on, is fixed income, relative value trades, and the focus in the equity market on the sectors that would have outperformed in the sort of environment that we had, say, from last April to August when the Fed pulled the plug on QE1. And there are going to be nuggets within the equity market to own in that sort of environment.
A final question, if I may. In the last decade, we've seen two major bear markets in stocks. We've also seen two recessions. And, Dave, that is so unlike what we experienced the previous 2 years, or in the 80s and the 90s. We'd go for almost a decade in between recessions. Are we returning back to a normal business cycle of 3 to 5 years, or are we going to experience something entirely different?
Well, it depends what you want to define as normal. I think normal in the context of the post-World War II period was, recessions are short affairs, expansions are long and drawn-out affairs, and that recessions really happen maybe every 7 to 10 years, or maybe every 5 to 10 years. But what you do find after a post-bubble credit collapse, after a balance sheet recession, recessions come much more quickly, more like every 3 years. And I think that Japan may be an extreme example, but certainly a modern-day example of a post-bubble deleveraging phase would attest to that. It's not been perennially in recession, but the downturns happen about every 3 years. And it may not be any different this time around.
Well, we've been speaking with Dave Rosenberg. He's chief economist and strategist at Gluskin Sheff. And Dave, if our listeners would like to follow your work, how could they do so, please?
Well, if you go to the Gluskin Sheff website, www.gluskinchef.com, and have a look at the website, and you'll be able to click on the icon that has my research. I'd also advise people to actually go through the entire website and look at our philosophy and look at our different strategies across the gamut of asset classes. And I think that you'll be duly impressed. If you want to go on the website, www.gluskinchef.com. If you want to email me directly, it's rosenberg@gluskinchef.com, and look forward to hearing from everybody.
All right, Dave. Well, listen, I want to thank you for coming on the program and being so generous with your time. Thanks for joining us.
And thanks for inviting me. All the best.
You're listening to the Financial Sense News Hour at financialsense.com.
Let's do the Uncle Sam Boogie.
If you go out every day and you take the risk and you create a job, I'm proud of you. Now, this is the opposite of the Obama model. Remember, the Obama economic model was illustrated when he went to Brazil recently. Having stopped all American drilling for oil and gas offshore, he had the nerve to go to Brazil and say to the Brazilians, I am proud that you're developing oil and gas offshore. In fact, I'm proud that we have loaned you several $1 billion to buy equipment, by the way, for a company owned by George Soros. And then he showed you how totally out of touch with the real world he is when he said, we want to be your best customer.